of this as your financial toolbox. For the next 30 minutes, we'll give you the latest money news, cut through the jargon, and tap into expert advice, all designed to help you take control and build a stronger, healthier financial future. On today's show, we'll break down how prices you pay for goods may be higher due to tariffs. Plus, you no longer have to remove your shoes at the airport, so is having TSA PreCheck still worth it? We'll dig in. And what high interest rates mean for your savings accounts and mortgage rates. While the tariff-driven bump in inflation many economists feared started to emerge in June's consumer price index. Inflation reaccelerated last month, rising to its highest level in 4 months. That means the prices you pay for everyday goods and services ticked higher, and in some cases, that is due to President Trump's tariff policies. We saw price gains in categories like appliances, toys, clothing, and furniture, all goods that are heavily imported and therefore vulnerable to tariffs. Appliance prices jumped 1.9% in June. That was the biggest monthly spike since 2020, when Americans were locked down at home and investing in their living spaces. Plus, Trump's 25% to now 50% tariff on steel and aluminum affects products like washers, dryers, and refrigerators, pushing those costs higher. Meanwhile, toy prices rose 1.8%, and with about 80% of toys sold in the U.S. made in China, this category is heavily exposed to any tariffs on Beijing. And sporting goods prices climbed 1.4%. The World Trade Organization says nearly 2/3 of sporting goods imported to the U.S. come from China. The U.S. is also a major importer of furniture and apparel. Prices for both rose 0.4% last month. Now, it is important to note that price gains in these areas can be offset by declines elsewhere, but this data does point to growing pressure in tariff-sensitive parts of the economy. Well, travelers, feel free to tie up those shoelaces tight, because people traveling through domestic airports no longer need to remove their shoes while passing through security. For many years, that was a benefit only available to people in trusted traveler programs like TSA PreCheck. So now that everyone can keep their shoes on, is TSA PreCheck still worth it? Here to weigh in is Ben Walker, our senior writer on the credit cards beat. So Ben, if keeping your shoes on is no longer exclusive, what are the other perks of TSA PreCheck that still make this worth the money?
Yeah, I mean, I still think TSA PreCheck is going to be worth it for a lot of people. You know, it's fairly cheap or free with certain credit cards, and it still offers, like you said, multiple perks that, your standard passenger is not going to get. That includes, you don't have to remove belts or light jackets. You can also keep electronics and eligible liquids in your bags. And in some cases, you might also be able to avoid the full body scanners, which take longer, and instead use the walk-through metal detectors. For me personally, I don't want to give up the convenience of not having to remove large electronic devices from my carry-on luggage anytime soon, especially since I normally travel with my family. So I don't want to have to worry about removing laptops, tablets, and cameras while juggling my kids, strollers, and car seats. Honestly, it just seems like a bit of a hassle to me.
I feel you there, Ben. And what about the line situation? How much time are you really saving with PreCheck these days? Is it still a noticeably faster experience, especially now that programs like Clear are more widely available?
Yeah, I mean, great question. I would say in many cases, TSA PreCheck lines will still move quicker than your standard TSA lines. It obviously depends on the airport and the specific checkpoint you're at. But like the TSA website says, about 99% of TSA PreCheck passengers wait less than 10 minutes. So there could be multiple reasons for this. This could be because TSA PreCheck travelers are more experienced, meaning they already know what they're doing. And they also have to remove fewer items from their bags, and they possibly don't have to do those full body scans. So all of these reasons could point to TSA PreCheck lines moving faster than your standard lines. But one caveat to all of this is that wait times and even TSA guidelines can be highly dependent on the specific airport that you're traveling through. So in some cases, you might get through the standard line quicker than your friend in the TSA PreCheck line. It just depends on what's going on that day. But overall, I have more confidence using TSA PreCheck, especially paired with the Clear Plus membership. I can often go straight to the front of the TSA PreCheck line and be through security very quickly.
And Ben, can you break down the cost structure of TSA PreCheck for us? What exactly are travelers paying for, and how long does it last?
Yeah. So the application fee for TSA PreCheck runs between $77 to $85. That's for a 5-year membership. It comes to about $15 to $17 per year. And there's a range in these prices because it depends on which provider you're applying through, and there are 3 different providers. If you want to renew, it'll be between $60 to $70 or so to renew for another 5 years of membership. And some of the providers provide a discount if you renew online to make it a little easier. Just remember, there are ways to cut the cost of TSA PreCheck even more, even though it's already pretty low cost. One of the easiest ways is to have a credit card that covers the application fee. And there are dozens of these types of cards available, like the Chase Sapphire Reserve, Capital One Venture Rewards. So there are plenty of options to choose from. One last tip I would say is that if you plan to travel internationally, consider applying for the Global Entry membership. This membership can help expedite your entry back into the United States, and it also includes a TSA PreCheck membership. So you get multiple benefits for the price of one.
All right, Ben, thanks for that. Appreciate it.
Thank you.
Well, we're in the doldrums of summer, but that doesn't mean it's too late to plan a last-minute trip to escape the heat. Joining us now with some tips on saving for and paying for your next big vacation is Yahoo Finance personal finance editor Casey Bond. So, Casey, what are some tips would-be vacationers should keep in mind when they're saving up for that dream trip?
Well, the first thing to keep in mind is having that vacation budget in place. Do some research about how much your trip is going to cost you roughly, and then divide that number by the number of months you have to save. So that'll give you an idea of how much to put away every week or every month to reach your goal. Also, a good idea is keeping those funds in a high yield savings account. This allows you to earn a competitive interest rate. So while your money is sitting in the bank, you're growing that balance as quickly as possible. And then finally, consider automating your contributions. This takes some of that mental pain away from physically transferring money out of your checking account every month. And it just ensures that you're staying on track and consistent.
Okay, so that's good advice. And what are some other smart strategies to keep in mind when you're paying for that trip so that you're not overstretching your spending limits?
Well, several studies have found that about a quarter of people with rewards credit cards have points that are just sitting in their account going unused. So I would definitely recommend that if you do have a rewards card, you take a look and you see what rewards balance you have, and then see what the rules are surrounding redeeming those rewards and how you can boost the value as much as possible. If you don't already have a card or you're considering getting a new one anyway, look for a rewards card that has a sign-up bonus. So by spending a certain amount of money within a certain period of time, you can earn a sign-up bonus of rewards points that are often worth several $100s, even as much as $1,000 that can go towards that trip. And then finally, an alternative financing option to consider is buy now, pay later. A lot of these services allow you to break up the cost of, say, a flight into smaller installments. So as long as you make those payments on time, you will incur very little to zero interest on that purchase.
And how far in advance should you realistically start saving for a vacation? And is there a particular rule of thumb on how much to set aside each month?
Well, how much you're going to set aside is really dependent on your overall budget, whether you have, other expenses that you can cut back on to allocate more funds toward that vacation. But really, the sooner you can start saving, the better, especially if you're earning a good interest rate on, in a high yield savings account. That's really just going to boost your balance the more time you let it sit there.
All right, Casey, thanks so much. Appreciate your insights.
Thank you.
Well, recent changes to tax policy have eliminated EV credits that were designed to encourage electric vehicle purchases. Yahoo Finance's Pras Subramanian has the details.
I mean, look, you need to act now if you want an EV, right? So Trump's budget bill sunsets that federal EV tax credit of $7,500 for new vehicles and $4,000 credit for used vehicles starting on September 30th. So basically a month and a half here. While smaller state incentives are still there, the federal credit was sort of the main impetus driving the sale of EVs in America. It first began in the Obama administration in 2008, and Biden expanded that during his term, right, to include both the new and used EVs. And in addition to that, there's a point of sale situation where the actual credit actually gets deducted right when you buy, as opposed to waiting when you file your taxes. So it's just the best time to buy is right now. And if you want to buy, and then there's also the lease loophole, right? So lease loophole allows for you to lease any EV. It doesn't have to be American. Doesn't have to be under a certain price or a contingent upon your income level. You can lease any EV and get that $7,500 deducted from your lease payment. So look, it's the time to, if you want an EV, now's the time to get one.
All right, yeah, and like you're saying, you can save some money there. What are some of the tax credit eligible EV models on sale right now?
I mean, so for purchase, you're going to be looking at a lot of the American brands or cars that are made in America, which is beyond, the Cadillac, Lyric and cars like that, but also the Honda Prologue, which is made by GM in the U.S. That car also is available for the tax credit. It's a Ford F-150 Lightnings, and of course, how can we forget Tesla, Model Y, Model 3, Cybertruck? All those vehicles also made in America, and they are eligible for that loophole. And I'm sorry, for that tax credit. If you go to the Tesla website right now, they have a big banner that says, "Act now to get your Tesla before this goes away." So manufacturers are sort of talking about it. There's a bunch of inventory still available. I imagine by the end of September, it's going to be kind of dwindling. So now is your best time to get the best option in terms of availability.
Coming up, investors expect the Federal Reserve to hold interest rates steady in July. But what does that mean for you and your money? I'll break it down. Plus, we'll explain the correlation between interest rates and mortgage rates, and another installment of Ask Yahoo Finance Anything. That's next. The Federal Reserve is widely expected to hold interest rates steady at its July meeting, keeping rates in a range between 4.25 and 4.5%. But what does that mean for your money? Well, it depends on your financial situation and your financial goals. The Fed's benchmark rate, known as the federal funds rate, it's set roughly once a month, and it influences something called the prime rate. The prime rate is what commercial banks charge their most creditworthy customers. Your personal interest rate for things like loans or credit cards is based on that, along with your credit score and history. When the Fed raises rates, the prime rate tends to rise. When the Fed cuts, it usually falls too. The Wall Street Journal publishes the most commonly used version of the prime rate, surveying the 10 largest U.S. banks to get it. So what does this mean for savers? Well, when the Fed keeps rates high, banks often raise deposit rates to compete for customer cash, meaning you could earn more interest on your balance. Certificates of deposit, or CDs, may offer particularly attractive rates, though they're still below the peaks we saw in 2022. If your bank starts lowering rates, or if you're opening a new account, it may be worth shopping around. On the flip side, for borrowers, higher rates mean you'll pay more if you carry a balance on a credit card or take out a new loan. Mortgage rates are indirectly tied to Fed policy, and while the Fed is expected to hold steady until at least September, that still means home buyers are looking at mortgage rates hovering around 7%. While mortgage rates aren't directly set by the Federal Reserve, they are influenced by its policy stance. And you can see that connection in this chart here, which tracks the average 30-year mortgage rate alongside Fed actions. So what should home buyers keep in mind about current rates? And what's the outlook for the rest of the year? Joining us now with more insight is Melissa Cohn, Regional Vice President at William Ravis. So Melissa, we often hear that the Fed doesn't directly set mortgage rates, but it does influence them. So can you walk us through that relationship and how Fed policy decisions trickle down to home buyers?
So mortgage rates are really tied to the 10-year Treasury yield, which is impacted by the same data that the Fed looks at. So when there's weak economic data, bond yields go down, mortgage rates go down. At the same time, if the Fed sees that the economy is weakening, then they would be more likely to cut rates based upon that same data. So mortgage rates, bond yields, Fed funds rates all sort of travel in the same direction generally based on economic data and the rate of inflation.
Right, economic data, expectations, and given where we're at in the current environment, what do you think lenders are watching most closely? Is it inflation? Is it Fed signals? Is it the 10-year yields, or all of the above?
I mean, it's obviously all of the above, because the bond market is going to react to what the Fed does, what the Fed says. If the Fed at the end of this month says that they intend to remain hawkish on inflation and they continue to worry about the inflationary impact of tariffs on the economy, the bond market will probably react negatively, and that will cause mortgage rates to go up. because the fear is that rates will stay higher for longer. If the Fed has the opposite statement and they take a more dovish look and say that if the rate of inflation remains where it is based upon tariffs and the economy continues to sort of muddle along the way it is right now, the Fed could say that they'd be open to a rate cut, and then the bond market would rally and mortgage rates would come down.
So with the Fed widely expected to hold rates steady at its July meeting, maybe cut in September, what's your call, at least directionally, on where mortgage rates could be heading in the second half of the year?
I mean, we continue to see that, the employment sector is stronger than the market was expecting, but not as strong as it has been. So a weakening employment sector, we've seen other weakening areas in the economy, and that the rate of inflation, while it's gone up a little bit on the retail level this past month, is still pretty much in line where, the rate of inflation has been. So my hope is that the Fed will cut in September and will indicate that further cuts are potentially will happen at the end of the year and that mortgage rates will settle down. I think it's all going to be based on what the Fed says at the end of the month and what they do in September. But my expectation is that we will see lower rates by the end of the year.
And if the Fed does end up staying on hold longer than we expect, which has become a more likely scenario in recent weeks, could we see mortgage rates stick near that 7% level, or are there other factors that could maybe bring some relief for buyers, even if we have this higher for longer interest rate environment?
Well, the bond market is very reactionary, and bond yields move up and down every day based upon current economic data, based upon geopolitical events, and a lot of other things. So the bond yields can drop and mortgage rates can drop even if the Fed doesn't cut rates.
And for people on the fence right now, do you recommend buying and refinancing later or waiting it out? What's the smartest move in this market that can be a little bit confusing?
If you're looking to buy, it's really about finding the right house, not about finding the right mortgage rate. So I would tell you to buy when you find that right home. And that if you can buy and you can afford the home at today's interest rates, when hopefully rates come down, you can always refinance. And then, it's a win-win situation.
Melissa, thank you so much. And you can scan the QR code below to find full coverage of mortgage rates. Well, market volatility brought stocks to lows in April and back up to near record highs today amid uncertainty around President Trump's trade and tariff policies. The whiplash has left many in or near retirement with questions, and we want to give you answers. So joining me now is Yahoo Finance's Carrie Hannon. Ask Yahoo Finance anything. So Carrie, some of your readers wrote in about this. One asks, quote, "I am worried about inflation coming back with all this tariff talk. Given how crazy the stock market has seemed to be this year and the cuts at the Social Security Administration, should I be considering delaying my retirement? I had planned it for next year." Carrie, what do you think?
Well, this is such an individual decision. I'm a big fan of working longer. The longer you can postpone retirement, the fewer years you need to support yourself from all your savings during retirement. With longevity, the idea of you retire at 65, you could have 3 decades to support yourself. So I'm a real big fan of pushing it back, but you really need to look at your own situation. One guideline that Fidelity often uses is if you're 67 and you think in retirement, you should have 10 times your pre-retirement income set aside. So that's just a way to look at it. But there's so many individual caveats here. But what I'd like to say is really, I encourage you, if you're healthy and you like what you're doing, by all means, if you can stretch it out a little bit more, because what it allows you to do is continue to put into retirement accounts to sort of stave off dipping into them. And potentially to push back taking Social Security to age 70 from your full retirement age, where you'll get the biggest check for the rest of your life. These are all things that are super positive. And if you're not 65 yet and you're with an employer with health insurance, boom, you've got some health coverage until then. So again, it really gives you some time. If you have a little leeway, also look about if you're worried about that volatility. Can you adjust your portfolio a little bit? Can you make some rebalancing so you have a cash set aside, enough cash to cover some living expenses through next year, at least, should the markets get a little volatile next year as well?
All right, Carrie, this next one, definitely top of mind. Another reader asks, can AI help me figuring out if I have enough saved for retirement? So can we trust AI with this, Carrie?
AI is not really great with math, to be honest with you, but I do think it can be super helpful. And in fact, I played with it myself with ChatGPT. I looked at it to see what, I asked some questions. It is wonderful to answer basic questions about retirement, and it's a great educational tool. I found the answers to be very clear, very direct. Straightforward. They counseled me at the end to talk to a financial advisor and to think about my own health, whether I might need to have more stocks set aside because investments in stocks so that I had more growth in my retirement savings in case I were to have longevity and longer life. So I asked, for example, what at my age, how much should I have of my portfolio in stocks? I asked, what is a target date retirement fund? And I asked, when should I start taking Social Security? And I would say it was super helpful what they told me. But again, they definitely covered the bases and said, go talk to a financial advisor for your situation.
And Carrie, you also got a question on Medicare coverage. Given some of the recent cuts and changes under the Trump administration, this reader says, I am flummoxed. I love that word, flummoxed. When it comes to the choosing the right Medicare coverage, who can I ask to help, or can AI help? Another reader wondering if AI can help answer these difficult questions for us.
I know AI is just so buzzy right now. It's top of mind. Yeah, AI, once again, like I said about the retirement planning idea, it can help you. It's a great way to compare what is Medicare, traditional Medicare, what is Medicare Advantage, what are the pros and cons of these things. It can give you some really good educational basics about Medicare. It's not going to tell you what the right plan is for you. This is a very personal decision, and all of these elements go into it. So I really do think, yes, by all means, you can check out, there's some good ones out there. To ask some questions about what it is that Medicare can do for you and what things you need to be thinking about. But you might, if you're working with a financial advisor, they should be able to send you, they might recommend someone who specializes in Medicare coverage to walk you through some of the possibilities for you. And you can also go, there's a couple of different places that can offer some free advice. The first one is and I'm going to look down to make sure I say it right, the State Health Insurance Assistance Program. These are in all the states and they're free right now. Medicare Rights Center also offers some help for you as well as going straight to Medicare. They've got some great resources there as well. But again, it's a big decision. Take your time. Yes, use AI to sort of get the nuts and bolts of it, but you're going to need to talk to somebody one-on-one to decide what's best for you.
We have a bonus question for you, Carrie. One of your readers says, I turn 65 later this year and am still working. Do I need to apply for Medicare? What say you?
Oh, that's a really great question because as I just said, work longer. So the point is, if you are employed at 65 and your employer provides health insurance, you should check with HR there. But yes, you should be perfectly fine staying on your employer plan. That said, you absolutely have to apply for Medicare. I think you have a 3-month window before you turn 65 and that you need to apply for. Don't apply for Medicare Part B, but you need to enroll in Part A. That's all you have to do. There's nothing beyond that, but you need to get started in the system that way. And then when you leave your employer, then you can step back in and do the other things. But again, you might call directly for your situation, but you should be covered by your employer at that stage, but you do need to sign up.